Welcome back to Bazaar Morning Call. Well, for now, the market is on fire, really. The Nifty is up almost 160 odd points and it's getting better by the minute. A lot of stocks, just look at BPCL, it's the top gainer right now, 2.5% higher. ICICI Bank is almost hitting 900 rupees now. It's been a very strong mover. This year, ICICI Bank is up about 25% already and has had a mammoth move. Eicher Motors, Bharti Airtel, Asian Paints. It's a secular move on the upside. Let's talk about some of the stocks in the news this morning. Interglobe Aviation is in focus as sources indicate that the Gangwal family is looking to sell a bit of their stake, about 2.8% stake for 2,000 crores. Now, the indicative price for the Indigo block deals are at 1850 rupees, which is well below the market price, about 6.5% discount. Now, let's not forget that the Indigo family cumulatively, the family and the trust owns about 36.6% stake. Out of that, Rakesh and Shobha Gangwal own about 23% stake. Now, 7 months ago, Rakesh Gangwal stepped down from the board, and at that point in time, he had indicated that he will sell his entire stake over the course of the many years. It's a period of 5 years over which he will be exiting his entire stake. So that overhang remains, that there will be a gradual exit. However, just the fact that he had already indicated earlier that he will be selling stake is something that is not surprising the market too much on the negative side. Remember, the stake sale was possible after the modification in the Article of Association, which allowed the sale of shares by promoters without seeking approval from the other. There was this long legal battle that both promoters had gone through. But most experts believe that while this will be an overhang, the business has moved on. Revenues have picked up, travel has picked up, crude prices are now down. So overall business prospects are strong, and that's why the stock has also moved up if you look at it in the last 3 months.
Oh, absolutely. So that's Interglobe view. Things are looking, overall looking good. Of course, it's got the sector has got many more competitors now as well to sort of be in the marketplace. Tatas, of course, are a big one now. Now, Godrej Properties is the next company which is on our radar. Remember, Godrej Properties kind of disappointed with their numbers relative to what the street was expecting when they reported quarterly numbers last time. But we are talking about slightly longer term. The Mumbai property registration numbers have continued to come in pretty strong, which of course is the dominant market for the company. 20% year-on-year growth is what we've seen. August traditionally records a sequential drop in registration, but this one has been very, very good. Mohit Malhotra is Managing Director and CEO at Godrej Properties. He's joining us now to discuss how are things looking and just to take stock of Q2 so far. Mohit, great to have you with us here. Thank you very much for being with us here on the program. Could you tell us what's the overall picture in Q2 so far?
See, overall, the demand remains strong, and we are on track to deliver, again a very good quarter. So, sector demand is now strongly picked up, and the momentum is very strong.
Okay. All right. When you say momentum is strong, can you give us some numbers? Overall, your sales bookings have been in Q1 at about 8.8 million square feet, which is a big growth year on year, but on a quarter-on-quarter basis, it's a fall of 35%. So on this base of 8.8 million square feet, what kind of growth do you see over the next couple of quarters?
See, we look at it in terms of value, if you look at in terms of value, we delivered close to 2,500 crores in Q1, which was actually the highest ever Q1 number we have delivered. Our overall guidance for the year is we would like to deliver a 10,000 crore number, and we are very strongly on track to deliver that.
Hi, good morning. You've done so well at Godrej Properties, right? Taken it to the level where it is, and now you're moving on. Is it just the entrepreneurial journey, or was there something else?
No, it's my entrepreneurial bug which came in and hit me. I feel it's a very exciting time to start up a new venture in the industry. So that was the whole rationale.
So you'll be in the real estate industry itself with your own venture?
Absolutely.
Okay. On the construction side or more on the consulting side?
No, I would, I'm still firming up my mind, but largely planning to raise a fund, capital, and then do development for the capital. So it's a more niche strategy.
Yeah, the reason I ask you that is, of course, you're candid enough to, give us that information. Is how do you see the market now? Because, we've seen such a revival on ground, it's visible, right? And the properties you list them and they're gone in a week. Rentals are now hitting new peak. We are way above the pre-COVID levels. So how do you see this market evolving from here?
See, if you look at the market today, there are two major things which are visible. One is, there is the cycle is turned, and we were in a down cycle for last close to 10 years, and there is the real estate business is a cyclical industry, and one can expect another 10 years of a positive cycle. So I think overall, it's a beautiful time in the industry. We are just at the beginning of a major bull run in the sector. Also, the competitive vacuum has got created. There's not more than 5-7 players in any major city, whether it's NCR or Mumbai, who can leverage and take benefit of this opportunity. So I think this is where companies like Godrej Properties would play a very large role. Will gain a lot of market share, and also given that the industry itself will be growing, we can expect company to grow at a rapid pace from here on.
Okay, Mohit, we wish you all the best for your new venture, and of course you've done great work at Godrej Properties. Just wanted to get some more information on the numbers that you shared with us. You said booking value guidance is 10,000 crores for the end of FY23. What is the progress as far as the new projects are concerned? You have projects in Nagpur, Wadala, in Okra, in Bandra as well. How much of these projects will get commissioned in the second half of the year and contribute to this booking value that you're guiding for?
See, Wadala we launched in Mumbai in Q1, and we had a fabulous sales. I don't remember the exact number. We are closer to 700 crores of sales in that project itself. We have launched the phase 2 of Okla in Delhi this quarter, and we are seeing an excellent response on that project. Bandra is a project where it's still taking some more time to get the clearance because of partner concerns. But otherwise, overall, extremely strong momentum. Remain very, very bullish about the future of the company.
What about realizations per square feet? How are they coming along?
See, the change in the market scenario and what I mentioned about the markets turning now has given pricing power to developers. Most of us have been raising prices to the tune of 3 to 5%. So we again took calculated price hikes in projects in Q1 and saw that it could be absorbed. So from a price perspective, the prices have been going up steadily. The good news is that now the cost inflation is slightly better than before. Steel prices are now significantly better than before. So overall, realizations are decent, are on track now. Profitability is being maintained through calculated price hikes.
All right. So just coming back to the numbers, right? I want to understand that apart from these projects that you have, Nagpur, Wadala, Okla and Bandra, any other markets that you're looking to tap, any projects in the pipeline that one can expect? Not just in this year, maybe over the next 1 to 2 years?
See, we are signing multiple projects, evaluating opportunities in the major cities. So, the strategy remains the same. We want to be in the top 4 cities. And we are looking at plotted developments in the tier 2 cities. So many new such projects will be announced in future. We have a very, very healthy pipeline right now on business development front.
And because of the momentum that you're seeing, would you be scaling down your debt as well? I mean, your debt actually quarter on quarter has gone up. You're almost sitting at 1,000 crores of debt. Do you plan to bring it down?
Yeah, see, if you look at the company today, the debt equity is less than 0.1 today. We would ideally like to deploy more capital and in new deals, and our targeted range for debt is closer to 1.5. So we have a huge opportunity now to deploy more capital. We're not worried about taking more debt. The debt levels will increase as we spend more money on new deals and business development.
All right, Mohit, we'll leave it there. By the way, just a quick point. now that you are going out on your own and raising a fund, etc., what structure would this be? And when you wear that sort of fund manager hat, which are pockets in the entire business where you see maximum opportunities? Will it be the entry level segment, low price homes, premium? I mean, where exactly?
I think I'll answer this question after January.
After January. Okay, all right. Mohit, we'll leave it there. Thank you very much and hope to have you back once that fund is up and running. Thanks very much. We'll take a quick break here. We'll come back. The market, I think, is doing just fine. We're up 154 points, 17,777. So this is absolutely a clean move so far after what was a gap up. No hesitation, no intraday dip. Nothing at all. I mean, and we've been trading for almost about 40 minutes or so. Sonia.
Okay.
Okay, well, yeah, the market's looking quite good. In fact, the ingredients are in place for a trend day today. You make a first hour high and then you take it out. The Nifty repeatedly has struggled at 17,800. Today is as good a day as any to take it out. 17,777 is what we have now. And on the Bank Nifty, that corresponding level is 40,000. And this is where the highest amount of call buildup is. And if you take them out, then I think you could see maybe ferocious short covering. You've already seen a lot. But then, this is a market with momentum. Global Spirits is the next corporate on our radar. We'll be talking to the company. They've begun commercial production at the Jharkhand unit. They've spent around 120 crores on the capacity and have around 200 crore capex plan for FY23. To understand what this could mean for business, we are joined by Shekhar Swarup, Joint MD of Global Spirits. Shekhar, good morning. Thanks a lot for joining us. So, after this capex, what kind of additional numbers do you see going forward in terms of revenue and maybe even in terms of profitability?
Hi, good morning. So the new capex at Jharkhand, which was completed just a few days ago, increases our capacity by just over 30%. This will obviously directly translate to revenues and our bottom line in the next few quarters. We've got two additional projects that are in the pipeline, one in Uttar Pradesh, one in Odisha. In both these places, land acquisition is complete, clearances are underway, and as and when construction starts, we will give further updates on that.
Any expected date of
aside
completion?
From that, volumes
for these projects in Uttar Pradesh and Orissa, any date for completion?
So it'll be about 12 months from start of construction. We expect start of construction to happen in Q4 or in Q1 of the next financial year.
And what would be the cost of the project? How much would you be investing?
It's between both of them, it will be around 300 crores. That's the anticipated capex as of now.
Okay.
But as soon as clearances are complete, then we'll have a more firmer idea on capex numbers.
So this 300 crores is coming in from where? From internal accruals, or would you be at some point looking to raise debt as well?
Largely internal accruals. Our model, which is based on supply of ethanol, extra neutral alcohol, as well as consumer business, both value and premium segments. It's a high cash generating business model. Most of our capex is funded through internal accruals, and working capital is funded through short-term borrowings.
So once both those projects are completed, how much does capacity increase compared to where it is now?
After both these projects are complete, we should have a total capacity of around about 1,200 KL per day. The caveat to this is, as I mentioned earlier, once the clearances are complete, that is when our capacities will get firmed up. But it'll be around about 1,200 KL per day once the entire capex cycle is complete.
Shekhar, could you talk to us a little bit about how prices of your inputs are behaving? I mean, I think there was a big surge in the price of broken rice. You had moved to buying rice from Food Corporation of India. So that was coming to you cheaper. Could you just talk to us through what's happening now?
So the main increase in input prices we've seen in the last 3 to 4 months has been fuel prices. Raw material prices have been stable after the change to FCI. We purchase about 50% of our raw material requirement now from FCI. The other half is still from the open market. We haven't seen too much inflation over there. On the other hand, fuel has been seen a huge inflation in the last 4 or 5 months. Going into September, I see some of that softening, but up till August, it's been quite dramatic, the cost increase in fuel. We've been able to pass through some of that through increases in our ENA prices, as well as part of our consumer business. We've been able to pass on some of those cost pushes. But going into Q3 and Q4, we're seeing some softening. Let's wait and watch and see if this can sustain for a longer period.
Let's talk about volume growth. You had targeted 100 million cases by FY25. I mean, going by the crowds at bars and restaurants, I think it'll be easy for you to achieve the target. But you tell us, is that guidance still intact?
I think there's some misunderstanding on that. It's 100 million cases of addressable market. Where we are present in just a few states of India currently. It's Haryana, Rajasthan, and Uttar Pradesh, a little bit of Delhi as well. The idea is to grow our presence from around 50 million cases of potential of market size to about 100 million cases. And thereby, if we grow the size of the cake that we are able to participate in, we can potentially grow our own volume as well. And that was the meaning behind that 100 million number.
Okay, got that. So you are doing currently a little under 4 million cases in the consumer business, right?
There's around 12 million cases a year is our volume from the consumer business, about a million cases a month.
Okay, no, I was talking about 4 million. That's 4 million a quarter. Is
okay,
what
yeah.
You're okay? 3 million a quarter.
3 million a quarter.
3 million a quarter. So what is the target at 12 million cases a year? What would the growth be for you over the next couple of years?
So at 12 billion, we expect this to grow by between 10 and 15%. Our premium brands, which are still very new in the market, those are seeing, those are seeing much faster growth as compared to our value segments. There we expect, upwards of 50% or even 100% growth in the next couple of years. But overall, 10 to 15% is our estimate.
Shekhar, just to go back to that earlier point about sort of raw material prices, of course, fuel, of course, is a big one. But say, for example, rice, 50% of the rice that you buy is from the open market, and that goes up, right? Meaningfully. I mean, there are forecasts that that is possible as well. But the ethanol you sell, the prices are set by governments, right? State governments, etc. So it's not as if you'll be able to pass that. Is that a risk as you see it?
Not really, because all our ethanol business is linked with FCI now. We are not making ethanol from open market purchase of raw material anymore. And the material we purchase from the open market is used for the alcohol or beverage side of the business, either conversion to our own brands or sale to others for their brands. So, it's a well thought through strategy where, the sort of sticky business, the conversion business of ethanol, the raw material prices are fixed. The thing that is open is energy prices, which are expected to come down. But on the other hand, the market where we have a little more control on pricing, we have, the costs can move around there as well.
Okay, we will leave it at that. All the best, Shekhar. It is a barometer of how much consumption has gone up, and clearly things are looking very good. So all the best for the future. That's Globus Spirits up 1.5%. But the other way to judge whether consumption has picked up or investments have picked up rather is the number of demat accounts in India, and they have crossed the 100 million mark in the month of August according to monthly figures from depositories CDSL and NSDL. To discuss where this growth is coming in from and the customer acquisition costs, we're joined by two gentlemen, Sandeep Bharadwaj, the CEO Retail at IIFL Securities, and Ajay Menon, the CEO Broking and Distribution at Motilal Oswal Financial Services. Gentlemen, morning to both of you. Ajay, let me start with you. At Motilal Oswal, can you give us the numbers? How much has the client base gone up compared to what it was, say, about 6 months ago? And how is the trend looking like in general? Ajay, you're on mute. If you can just unmute yourself, Ajay, we can't hear you.
Oh, sorry.
Yes, go ahead. Good morning.
Is this clear now?
It's very clear, yeah.
So I think for us in the last 6 to 12 months, there has been a continuous growth across our network, and we can see at least around 20-25% of growth you see in the last 6 months. And frankly speaking, the overall base in the network is increasing consistently because of the robustness of the overall systems which have been placed by SEBI now, and the overall model where the clients feel much more safer in the markets. I think the base is only going to increase the way the things are going, and we can see the overall expansion across our business network and the quality of clients which are coming in. We surely look at more of quality of clients coming in, so we can see the investments increasing on a continuous basis.
Gentlemen, hi. Good morning. Just a quick word on Sandeep, the size, Ajay, the size of these accounts which are opening, the new account openings. You know, I remember we've had Nitin Kamath with us of Zerodha, who said that some of these new openings are very small ticket size. So they're not very large in terms of transaction value, potential transaction value, etc. Could you tell us what has been your experience?
Right. So at our end, we are very much focused on the quality of the accounts which are coming in. So we try to track the accounts based on the margins which are coming for the clients. So typically, the number of accounts which gets opened at Motilal Oswal will be comparatively lesser to the discount brokers, but we look at quality. So the margin which we look at is anyhow anywhere in the range of 25,000 to a lakh. So average ticket size which we are getting in is around 40 to 50,000.
40 to 50,000, okay.
What is this 40, 50,000, Ajay? Sorry?
This is the amount of money with the client brings in when he opens the account.
Okay, the margin is 40 to 50,000 to start with, basically. Okay, got it.
Sandeep, good morning. I wanted your thoughts on if the pace of addition of clients has slowed down, because I was just looking at some numbers. In FY23 so far, on an average, 2.1 million new accounts were added every month. But in FY22, there was an addition of almost 3 million accounts. So are we seeing the pace of addition of new accounts slow down a bit compared to what it was last year?
Say, what we need to look at it, we need to look at DMAT in a, broader perspective. Now, earlier, the DMAT was the correlation of the equity markets. But as the category itself is increasing, now the mutual fund is also, to large extent, is contributing for DMAT growth. For the digital player, being there, they are also attracting bigger customer base coming through mutual funds. And last year, IPO itself contributed to a large extent. And that also see the last few months, there was no IPO. And this month, we saw a couple of the IPO, which also contributed increment in this month. So I think DMAT as a category itself is expanding beyond direct equities. And we are seeing growth, constant growth as far as numbers are concerned. But that will also, a lot more will depend on equity market behavior as well as cyclic nature of this industry. But I see the mutual fund is a one area which will continue to fuel the number of the DMAT account holders adding month on month.
No, so in your experience, when you say what is mutual funds are responsible for how much of the new account openings in the last 1 month, 2 months, according to you?
I was just looking at one data, Prashant. Yeah. So if you look at close to 60 lakh folio got added in last 3 months. Now, if I look at one customer, normally adds to 2.5 folio per customer. So which also, gives me, I need to validate this number, but the 60 lakhs folio, it means the close to 20 lakh new customers should come into the mutual fund space, which is like and whenever, category get expanded, mutual fund and SIP is the best route to start the equity journey. And post maturity of the customer, they try their hands in direct equities.
So Can you give us, Sandeep, the exact number for IFL securities? Because, in Q1, if you look at it over the past, say, 2-3 quarters, right? On an average, you've been adding about 1.5 lakh clients every quarter. In Q1 of FY23, that went up a little bit, not too much, about 1.63 lakh clients. Do you see that incrementally rise from here? What could the average be?
We are a lot more focusing on the quality of the customer, so where the trade activation can continue to grow up, and and the core cost of acquisition, because for us these two things are equally important. So the margin of margins coming in accounts, as well as clients trading in whether it is a cash or derivatives, so that will directly relate to the margins which is coming to. So with the focus on these two parameters, we continue to maintain our growth in terms of demat accounts, as well as our trade active clients have grown 4x in comparison to last year.
Ajay, the last answer you said you compared yourself to discount brokers. Is there any other way to broke except the discount way in India now?
So I think we are very much robust in our model with research and advice and the distribution which we have aligned, and we are very focused on the overall model which we run by with our business network and the franchisees. I think we are very profitable, and we see that this is going to become the norm, because the best part is that when so many new clients come in, finally they have to know where to invest and how to invest and to what extent. So I think at the end of the day, it is not so easy to make money in the market without investing onto research and advice.
But just in terms, Ajay, but you would agree, just in terms of sheer market share between brokers, right? It's the discount brokers are far ahead compared to Go on.
So that is on the number of accounts, but I think we should look at the turnover of the brokers. There the difference will be seen, because number of accounts doesn't mean the actual turnover, right? So if I look at the actual turnover in the market broker-wise, I think that things will be looking very different.
How are they looking?
The number which comes out is
you would have those figures. Could you tell us the turnover, for example, for, I mean, just to give us some idea, some perspective. How do these numbers look, turnover-wise?
So frankly, we don't get those turnover broker-wise, but I'm sure at the overall level, we'll be in the top 5 when you look at the turnover in the overall scheme of things.
Okay, top 5. Sorry, go on.
Top 5, all right. But since we're talking about brokerage, your brokerage income in the quarter gone by, Ajay, was actually under a bit of pressure. It was down almost 10% compared to last quarter. Anything to worry about there?
That is not at all. Frankly speaking, I think this quarter will be much better. But the only point is that if you look at the last quarter, it was all about IPOs, and the overall IPO market was very hot. So the market was also very good. So surely the brokerage income is related to the market. So fairly, we can see that the market was also on the correcting mode, and cash market was comparatively down in a big way, and the volumes also. So that has impacted, and it has come back in the month of August. And we can see the turnovers hitting all-time high numbers as far as our turnovers and numbers are concerned.
Got it. Gentlemen, thanks a lot for joining us. That's on the number of demat accounts and the retail cult. The market is still surging, by the way. It's not letting up any steam. And a lot of forgotten stocks are making a comeback. I'll just point out a couple before we take a break. Schneider Electric, that's up 14% right now. I mean, I don't remember talking about it for long. Cafe Coffee Day is the other one. Coffee Day Enterprises, of course, the name of the stock. That's also doing quite well. We'll take a break. We'll come back, and of course, we'll address fresh strategies with Mitesh Thakkar. Welcome back. Like we've been pointing out, the market's been doing rather well, and now we got first hour high in question for the Nifty. That's at 17,792. Why is that important? Because 18,000 is where you are beginning to see some bit of fatigue. Last high also was 18,000. The market did not close above that. So from the algo trade point of view, that becomes your level where profit taking would have happened, obviously, maybe 5 or 6 months earlier. So that's why today's high now becomes important to track for a day trader. Mitesh is back with us. Mitesh, strong first hour. What's your call now here? If someone's long, should you take it off here or just carry? And what's the calls now? At 10 a.m.
So I think this is the level which I was talking about, 17,750 and 17,800. So we are right in the middle of that. But the structure, is marginally improved. The indicators have started slightly expanding. So this could be a breakout possibility on the upside. If that happens, you rightly highlighted the next level, which is around 18,000 levels. We have had two highs over there. So assuming that we can, possibly look for a move till that level, I think now a good idea would be to trail the stop loss just below 17,700 on this spot Nifty, which is about 60 points lower. Having said that, my recommendations are also on the long side, despite the fact that we are at the hourly pivot levels. Wipro and BPCL are the buy calls. Wipro is breaking out with a gap today, so that's a buy with a stop at 408 for targets of 422. And BPCL, of course, I think the crude movement is playing a part here. Again, a gap up and a good strong price and volume action here. That's a buy with a stop just below levels of 330 for targets of 346.
Okay, Mitesh, thanks a lot for that. A lot of stocks buzzing around. So let's shift focus now from equities, take a break and talk about the commodity space. Manisha Gupta is joining in. Manisha, what's the one commodity that you're looking at today?
I'm not taking my sight off crude oil prices, Sonia, because we have seen very sharp declines onto that one overnight. 5 to 6% of a cut is what we saw in WTI and Brent prices, so much so that we're trading at the lowest point since the month of Jan. So it's a 7-month lows in case of crude prices that you're looking at. So the prices are at levels that you saw prior to the Russia-Ukraine conflict. So we seem to have given up all of that premium. We did see prices run up to nearly $123 a barrel at that point in time, but just about holding 82 to 85 kind of levels in the international markets right now. It also has to do with the strength in US dollar. There are concerns over sluggish demand that seem to be weighing in, and the kind of data that we have seen in from China, all of that has been on the weaker side. The trade data that came in yesterday did show export and import numbers both on the weaker side. We also have seen the Chinese crude imports itself decline by more than 9% for the month of August on an year-on-year basis. There is a lot of rationing happening in case of China as well, and that seems to be weighing onto the markets there. It also has been about on what the European countries are doing to rein in the rising prices there. We do understand that the UK Prime Minister is going to unveil perhaps an energy rescue plan today. And then you have the European energy ministers meeting on Friday as well. So the next couple of days are going to be quite interesting in sense of what development comes through because of that. And then you have the interest rate hikes. That seems to be weighing onto the crude prices also. ECB might hike rates between 50 to 75 basis points. The jury is out on that one. The US Fed meeting is going to be followed then on September 21st. We already have seen Bank of Canada raise interest rates by 75 basis points. That one now stands at a 14-year highs. The only reason that you have seen some buying come in on the lower side today is the statement after Russia said that they will not supply to the US-led price cap supporters within the European nations there. And then there also was a report from IEA which says that they are raising the global oil demand outlook and they are looking at higher supplies coming in from US markets. So that is another thing that the street is watching out for. I want to put on screen on what the prices really have done. So on a week-on-week and a month-on-month basis, we have turned negative when it comes to the crude oil prices. Natural gas clearly have seen a lot of cut into this week, but on a monthly basis, it still is holding on a firmer note. What has seen a very sharp decline also is the gasoline prices down on a week-on-week and monthly basis. But heating oil, because we have seen strong demand continuing in case of the markets, there is stocking happening ahead of the winter season as well, and is the reason you have seen still positive moves continuing for that.
Okay. All right, Manisha, thanks very much for that. So that's oil prices very much in the center in a good way. I mean, prices have come up very sharply and they're at more reasonable levels now. We'll take a very quick break here. We come back with our special segment. It's the economy. My colleague Lata will get chatting with Vetri Subramaniam of a UTI asset management company to discuss the Nifty's remarkable performance in the quarter gone by. Stay tuned.
Well, it's Onam and there's celebration not just at home, but on the screen. India's Nifty is the best performing index among large markets in 2022. As you can see, we will run as many indexes as possible. Now, this is partly because India appears lately to have become the flavor of the season with FIIs as well. Bloomberg data shows that in the quarter ended, 3 months ended August 31st, India's weight in the MSCI Emerging Market Index jumped to the second highest, beating Taiwan. Now, China, of course, is still the weightiest, but let's take the India-China comparison. India has hugely outperformed China over the past 2 years. India's weighting in the MSCI Emerging Market Index as of August 31st is 6% higher than what it was 2 Augusts ago, while that of China is down 9% since August 2020. What appears to be working for India is that whereas Indian markets rebounded very sharply from the COVID lows of March 2020 because of revenge buying, because of higher retail investors' entry into equities, the Chinese stock indexes have been falling due to the regulatory crackdown on big tech companies, followed by a strict lockdown due to COVID. Now, Russia moving out of emerging market index is another factor that has made India weightier. But the icing on the cake is the latest buzz from the market that JP Morgan bond index may include India in its emerging market bond index. Morgan Stanley wrote a report on September 2nd that most investors that JPM spoke to either support India's inclusion or at least don't object. Here again, Russia's exclusion could be creating a need for more good quality paper from deeper markets. So not surprising, while India saw $33 billion getting pulled out by FPIs from last October 21 to June of this year, since July, foreign inflows into equities have touched $7.5 billion or approximately 59,000 crores. Why has the tide turned? To get an idea of what investors are saying, I have with me Vetri Subramaniam, Chief Investment Officer at UTI AMC. Vetri, because he has just returned from an extensive tour of Europe and the United Kingdom. Vetri, thank you very much for finding time for us. Straight away, that is the first question. Your newsletter gives the impression that foreigners are thinking differently about India. Tell us what you heard.
Yeah, thanks for having me, Lata. And since you've reminded me, happy Onam to everybody watching the channel and celebrating today. I was talking to investors as predominantly UK and Europe. And, this was the first trip in almost 3 years because one hasn't been outside because of the pandemic. But very clearly, there's a big shift in the thought process. I think some part of this is geopolitics. I think more and more investors coming to recognize that, the US-China relationship is potentially the, biggest sort of conflict on the global stage, over the next few years or even decades. And therefore, they're starting to think about how to ring fence their portfolios more appropriately. And in that context, actually, India starts to, stand out. And this is true whether we talk to equity investors or to fixed income investors, because once you sort of say, I'll take a China view separately because of, all the concerns about their economy and geopolitics, then India actually becomes the most dominant, country that they would have to consider in their EM allocation. And I would say particularly on the fixed income side, you mentioned this, Lata, I think actually there's pressure from a lot of investors now to, get India within the investable universe, particularly after the exclusion of Russia and concerns about having exposures in China. So certainly this is a tune which is playing out to India's favor at this point of time.
Could you elaborate a bit on this geopolitical thing? That's interesting. Because US and China are at, loggerheads, India is seen as a safe bet where, policy will not rock the boat. Is that the thinking?
I think so. People are concerned about what the implications of having large exposure to China are. In a sense, what's happened in Russia over the course of this year has started to make, geopolitical risk a factor in investor decision making. I don't think that has been the case for the past 2 decades because, when you see things like US companies suddenly having to pull out, or even European companies having to pull out overnight from Russia, and we know that the European banking system actually is still to sort of truly disclose how much it is exposed to Russian companies, then all of this starts to become a consideration in investor mindset that I've not really thought of about this as a risk, but if the conflict escalates, then, how should I think about my risk? So India tends to benefit because it's seen as sort of being, on the sidelines. And I think, most investors we spoke to sort of appreciates India's stance in terms of the strategic autonomy that we have. And in fact, I would say they sort of understood India's position as enjoying strategic autonomy in terms of how we take our decisions.
Oh, that's good to hear. I mean, I can imagine a US FDI investor, what he must have gone through when Trump declared war on China and how European investors would have felt, bankers would have felt when suddenly Russia, you couldn't sell a dollar or take a dollar from Russia. I mean, exactly. Now I appreciate what you're saying. Okay, in your newsletter, you're also speaking about a certain longer term recognition that India is a damn good tech place. because of this unicorn. Was that also a chatter?
I think so. And obviously many of these global investors not only allocate into secondary markets, pension funds, family offices, private wealth managers, insurance companies, they also allocate to VC. So actually the sense that we get talking to a lot of these investors is that in India, they're actually using both approaches to get invested. One is allocating to VCs because, India is a very, very interesting startup economy from their point of view. And remember, the Chinese market, the VC market, was actually a very closed market because this was a market where companies started homegrown, and really when they scaled up is when they came to the public markets. But I think in India's case, what most people recognize is here is an opportunity to actually get into companies at a very early stage. And India doesn't have a closed internet, though, of course, there are various rules in place to sort of make it more safe and secure from India and our point of view of our sovereignty. But it's still seen as being an open economy for companies which can create a strong tech business in the local economy. And obviously, it helps that we're already seen at the cutting edge in terms of a lot of the digital technologies, be it the India stack, be it the payment system. So, I think in that context, India once again sort of figures right at the top in terms of a geography that people are looking to allocate. So, I would tend to be optimistic about not just, I think, the overall flows that could come from investors into equities in the secondary market, but also through the FDI route. But, I should also point out here, because I sometimes see people extrapolating this into a logic for markets getting repriced all the way to the moon. End of the day, these are asset allocators. They will be conscious of, valuations. But yes, we will benefit from the fact that the overall perspective that they have on India is net positive.
There's valuations to the moon is also there in my question list for you. But before that, let me just, refer to this interest in India. Right now, the money is coming only through GEM funds, global emerging market funds or Asia funds. You think that we can get more India dedicated funds? At the moment, that's so negligible.
That's true. When you look at the total amount of FPI money in India, a very small part of it comes through country funds and very small part through country active funds. The large part actually comes through GEM and EM or Asia strategies. But remember, the same was true even for Japan going back maybe 30 years. The same was true for China maybe till about 10, 15 years ago. And there came a point in time where it was a bit of a tipping point where investors said, look, this economy is too large for us to depend only on a look-through exposure that we would get by going through an Asia or an EM strategy. We need to have a focus on investing directly into India. Obviously, I'm talking my book over here because we're India's oldest investment manager running large number of global funds available to these investors. But we certainly sense at the margin compared to 3 years ago, a lot more investors now starting to bite the bullet and say, India is too important for us to just allocate to a global fund or an EM fund. We'd now like to make that allocation directly into an India strategy. So I think that's clearly a tone that we are picking up. And again, Lata, you also mentioned fixed income at the beginning. And I should point out over there, UTI put in place a sovereign ETF for bonds at the Amsterdam Stock Exchange earlier this year. And obviously, everybody is waiting to see when and where India becomes part of the benchmark. But I think, these sort of routes for people to get into India will certainly see a lot more interest. It's just a question of putting together the access.
No, I was coming to that. I had heard about this, ETF that you have, listed in Amsterdam. This is very interesting. FPIs we have spoken to, as well as the ones whom Morgan Stanley and JPM claim they have spoken. The only hesitation is that this long listing process with SEBI, etc. What you're saying is that if you're listed an ETF of Indian bonds, you can shorten that route.
Absolutely right. I mean, there will be some institutions who say we invest, we want to go directly into the market, but there's a large number of people, whether it's again insurers, pension funds, they don't really care to go directly into every market. They are quite happy allocating into an EM bond fund. From their point of view, we are able to provide a India ETF in Europe, which is settled on the European system. They would be quite happy to come in. I think what they're all waiting to see is when does actually India come into the index? Because, taking off-market bets is always difficult, more so for bond investors. I think equity investors have always understood going off benchmark as a source of alpha. Bond investors tend to be a lot more conservative, and therefore I think for them the country inclusion into a EMBI becomes very important.
Oh, that's big. In the beginning of the year, it looked like 81 and 82 for the rupee. But if this is how things will fructify, it looks like the rupee has a great run.
We keep discussing currency, and this is the other point I want to make, because I keep hearing this chatter everywhere. Oh my God, the DXY is so strong, but it is not the DXY which is so strong. It's actually a free fall in three of the biggest, constituents of the DXY, which is the euro, the Japanese yen, and the GBP. So, this time around, the rise of the DXY is nothing like what it was in 2013, or for that matter, 2008-9, where the EMs were in free fall. Yes, other DM currencies were also falling. This time, the DXY is rising simply because three of the largest constituents of the DXY, the three that I named, are in free fall. So when you look at the Indian rupee, please keep in mind, the rupee may be falling against the dollar, but it's currently appreciating against the GBP, it's appreciating against the euro, it's appreciating against the yen, and it's even appreciating against the yuan.
Yes.
So, the Indian rupee is not a weak currency at this point of time.
Yeah, actually, maybe you should watch CNBC-TV18 a little more, because my colleague Manisha did chapter and verse on this, on India, rupee versus various currencies. So, this is very good lessons for us as investors. But the big question, valuations to the moon, and a valuation table is coming up even as you speak. We are the most expensive market. Is that a chatter? Should we assume that the 3 months last July, August, September money can continue if valuations are so high, or will that be an obstacle?
Well, let me put it this way, Lata. I can't predict what investors will do, but if investors ignore valuations, they will pay a price for it. We said as much a year ago when valuations were, 2 standard deviations above long-term average. It didn't matter which metric you looked at: PE, price to book, forward earnings, 24-month forward earnings, dividend yield, free cash flow. On every metric, the market was expensive, and we've seen the outcome over the period of a year where, effectively the markets have done nothing. So I would be conscious about the fact that if valuations are at a premium to the region, certainly some of the asset allocators are going to hold their bullets for a day where valuations become more favorable. If I just look at valuations of India relative to our own history, the only point I would make is that yes, we've come off the averages, but we haven't yet gone into what I would call as rich territory as we were a year ago, because prices unchanged over a year, earnings up almost 40% over a year. You are still sort of derated compared to a year ago. So we're not 2 standard deviations above average, or even above 1 standard deviation of the average when I look at our own history. But compared to the rest of the world, we are very expensive. And just one caveat here: as much as a lot of the economic data for India looks good, as much of our geopolitical situation, etc., looks good, if the world is going through a very difficult period in terms of growth, some of that will certainly reach our shores as well. And, you could see earnings cuts, you could see GDP cuts. More importantly, the earnings cuts are what will, really trouble the market. So, you've got to be, I would say, hold your horses there, and, always presume that the pendulum will oscillate between greed and fear, pessimism and optimism, and choose your point accordingly.
I have a lot more questions for you, actually, in terms of some people even upgrading earnings for banks. Unfortunately, out of time, Vitri, but you're leaving us with 3 very huge takeaways. One, that geopolitically India is being seen as a preference, and a reliable one at that. 2, India's tech image is attracting a lot of money. And 3, people are asking for India dedicated or India allocation within the emerging market index. That's very, very positive for India. We have to wrap up on that optimistic note this Onam Day. Greetings to everyone who's celebrating out there. Chartbusters up next.